Welcome back to the Williams Real Estate Channel. Today we are discussing how the current cycle will come to an end prior to the next cycle beginning. So it's fascinating. I find this absolutely fascinating. Studying the 18-year land cycle, or that some people call it the business cycle. You can overlay it with many other cycles, like the long-term debt cycle, the war cycle. This gives us clarity, gives us perspective of where we sit in the market, so we can prepare for the future, not get overwhelmed with all the noise in the media, because we've been here before. And if you study the cycle, use the framework, you see the cat, you can understand why this is all happening. You can overlay it from many different angles and be prepared for the future and not get carried away with the fuss, like what a lot of people are doing now and buying up a lot in Brisbane because of the Olympic Games, or Perth or Adelaide because they're booming, or Darwin a lot these days because it's booming. As people get priced out of Brisbane, Perth, Adelaide in the third quarter and start to decentralize out into the fourth and final quarter, where we see the likes of even South Australia, regional WA and Queensland all booming. But when you buy a property, you buy the future growth. You don't buy what has happened in recent years. So we haven't been buying in Brisbane or regional Queensland since late 23, early 24. We are now sowing our seeds in the likes of Sydney, Melbourne, and we are starting to pluck off the low-hanging fruit in the likes of regional VIC, New South Wales, for the future growth cycle. So there's always a market to invest in. There's always a moving target. As an investor, you need to work out where you want to put your money at the end of the day. If you want to put it in cash, in gold, silver, in the stock market, in crypto, if you want to put it in real estate, what type of real estate, if it's residential, commercial, entry level, there's lots of different options. There's many ways to skin a cat. And the purpose of this video is to discuss how I see this current cycle coming to an end, as we are on this blue marker. Equivalent point of time now is early 2007 in the prior cycle, or if we go back one further, in the late 80s, 1988, 89, prior to the market going through the recession we had to have in the early 90s. Or if we go back again to the prior cycle before that, which was the late 60s, big boom up into the late 60s, which ultimately ended in the early 70s. Well, again, in the early 70s, it's 1972, 3, 4, hard downturn, nearly took out Harry Triguboff. At the time, we also saw an oil shock. And people, I get a lot of comments these days saying, how can you know what happened back then? You weren't even around. I was born in 1993. Yes, I wasn't around, but you can still study history. You can look at long-term trends. You can study history, and the further back you go will allow you to paint a picture and understand where we are going into the future. If you study history, it'll allow you to be prepared for the future. We've been here before. So we're seeing it now with high property prices. There's a wealth divide between people that have property, that have been prospering for many years, that people who don't have property, who have been falling further and further behind, who are very disgruntled. I get it. It's even in my own family. My older sister thinks everyone should have one house, social left green type of views, and very disgruntled. Obviously, she's older than me and she's got nothing. Where we are now in the cycle is we've been here before. High inflation, high rates, Everyone's getting squeezed until the market turns, recalibrates, and we go through the next cycle. So people have been asking me why we're still buying if you can see a coming downturn on the horizon. There's always a market to buy in. There's always a type of property. There's always a deal. And there's not one property market. There's many markets and sub-markets, but now is definitely the most crucial time to get on the right side because it's all going to come tumbling down. The market's going to recalibrate, and a lot of people are going to be left high and dry in the years ahead. As Warren Buffett says, you only discover who has been swimming naked once the tide goes out. The tide's starting to go out. I'm already seeing it in different asset classes. So we will run through these bullet points. I thought this is probably the easiest way to describe it. I did a bit of a brain dump how the current cycle will end and the next cycle begins. It's an evolving beast. There's never one moment in time saying, okay, the cycle's over, the new one begins. It ever consistently evolves, and we keep moving through as the global economy plays out. The 18-year land cycle is used to give us guardrails, perspective of firstly, where do we sit in the market, being on the blue marker and the slide before early 2007. And then from that, you can peel back the layers and look at how every market performed throughout history, how each asset class performed throughout history. So then you can work out where to put your money for the future years ahead. This is what I do. This is by no means financial advice, but this is my story. This is how I invest. The philosophy of my investing is within the framework of the 18-year land cycle. So how I see it all playing out over the next couple of years is, number one, high cost of energy. So we're already seeing that. That's an obvious one. Likes of electricity and gas, especially this time round, this one's going to be a massive one. Big, high inflation, hard downturn, because the federal government are not building new coal-fired power plants. They're trying to move away from that into renewable energy such as wind, solar, hydro, which is restricting the supply of energy. Meanwhile, they're importing a heap of people from overseas, migration, heap of migration, the highest migration levels on record. That's demand. So more demand's coming into the system, and they're restricting the supply of energy. That's creating a high cost of energy, which ultimately filters into inflation of everything, which filters through the system. So we're just starting with electricity. We've also got a transition into new technology, so electric vehicles. I mean, only in the last couple of weeks, there's been a 15% increase in demand for electric vehicles with the higher cost of fuel. So that's electric vehicles, AI, massive data centers being built throughout the country. That's massive demand on electricity. And at the same time, they're not providing the supply which is needed for us to be sustainable long term by way of building new coal-fired power plants. There needs to be one built in every state to generate enough electricity. So that's not happening. So hence why we've been in a high inflation environment for the last couple of years, but we are in the land boom. History shows during the final stages of the cycle and the land boom, winner's curse, credit expansion, a lot of investment is deployed. That's inflationary. And we've also got this time around, a big left-leaning government, big spending government, big taxes, taxing and spending and shutting off the electricity supply. Hence, we've got high inflation. Now, to add insult into injury, we've got the conflicts in the Middle East, restricting fuel supply. I mean, Iran provides about 20 to 25% of oil to the markets, and that's currently being shut off. Hence, fuel prices are going through the roof. we're seeing $3 at the Bowser. That will also filter through the system. Everything is driven by fuel, transport of goods and services, farming equipment, harvesting equipment, mining equipment, transport, everything is run by fuel. So high costs, input costs, meaning higher output costs. So we've seen a massive spike in the last couple of weeks where fuel's gone up 30 to 40%. That's going to filter through the whole system. So brace yourselves, get ready for high cost of groceries. So inflation is going to continue on picking up. This is a classic setup we saw in the early 70s when we had an oil shock. Look up oil crisis of the 70s. We're about to go through exactly what happened then, but this time around, it could be even worse because they haven't been building enough coal-fired power plants to lean on. So it's happening to an already inflamed situation. So it's going to be massive. So inflation is going to keep going up. Interest rates are going to keep going up as the RBA doesn't have any other source to tame inflation other than whacking rates up. So rates are already going to rates going to keep going up. I mean, we've already seen it, 2 rate rises this year, and the markets are now pricing in more rate rises to come. So, I mean, I personally fixed all my loans last year at 5.5% as the cycle gave me that framework. The cycle suggested that later stages of the cycle, inflation picks up, interest rates follow, which ultimately is the final setup that ends the cycle. I didn't know we were going to have this high inflation fuel crisis. End of last year, everyone was tipping rates are going down. My mortgage broker couldn't understand what I was doing. It's like, why are you fixing in rates now? I took it as an opportunity where they dropped them 3 times in 2025. I thought it was crazy that they were dropping them because that was only going to be inflationary and they'll end up having to raise them up again. Hence, we're here now. And I took it as an opportunity to fix the whole thing. And at the time, I was like, well, I'd rather pay 5.5%. I couldn't see them dropping any rates further than that for 2 years. I fixed for 2 years in November 2025, which gets me to November, December 2027, where they roll out. I was contemplating even 3 years, but I think shit's going to hit the fan before then. So we'll get to that. So interest rates are going to keep going up. Whether or not it's worth fixing rates now, talk to your bank, your mortgage broker, but now the markets have priced in rates are going up. The fixed rates are probably all higher now than the variable rates, so it might not make sense at this stage. However, with the way the fuel crisis is playing out and inflation, I can see the RBA continually whacking rates up to even 5, maybe 6% at the RBA, and the banks put on 2% margin on top. So I wouldn't be surprised if, the big banks are all lending 7, 8% by the peak over the next couple of years. So that is a classic setup. Business growth will slow due to the higher costs of energy and debt, interest, which is filtering through the whole system, which is putting up the cost of materials and labor. So that's restricting growth due to higher operational costs. So businesses will start laying people off because they'll need to start saving money, shoring up their balance sheets. So we'll see unemployment going up over the next couple of years. Businesses will go broke. Not every business will survive. It's like a fire going through a forest, burning off all the dead wood. So all the zombie businesses that have ridden the wave of cheap money over the last few years and ridden the wave of the market cycle and have got themselves into too much debt and have over leveraged themselves, grown too quickly, got big payrolls with people who aren't as skilled. They've just grown off the back of this wave. We'll see big and small businesses getting taken out. And the market will make you or break you. And we're going to see the market break a lot of people and businesses over the next couple of years. So unemployment will go up. Businesses will start seeing the writing on the wall, which they're already starting to see now. So they'll start laying people off to save money. AI is going to come in as well and start replacing people's jobs, making it more productive. Will continue to come in, will make businesses more efficient with less requirement on actual human activity and labor inputs. So that'll allow businesses to run leaner. So businesses will start laying people off. And then households will run out of money. If they don't have jobs, they won't be able to pay for rent and mortgages. Businesses will go broke that can't survive. Happens every end of a cycle. And the businesses that go broke, they won't be able to pay rent. So there goes the earnings of commercial real estate. And then there'll be a panic come mid-late 2027, big fire sale. So first to go, crypto. I see crypto going to zero. When people need money, if they lost their job, if their business is going south, if they've got an investment that hasn't performed well and they need cash, they need quick cash, there's nothing quicker than crypto. So when there's more sellers than buyers and there's nothing behind it, it'll go to zero. Big Ponzi scheme. So that's going to be funny to watch all play out over the next couple of years. All the crypto kings, all the crypto junkies are going to get their ass handed to them. Number 11, stock markets crash. I mean, we're seeing the markets getting spooked at the moment. I think they'll probably recover. I think Trump may get through this. And the framework suggests also that we're not due yet for big stock market crashes, but they're clearly sensitive. But I see the stock markets coming through this and running hard into late 2026, at which point Trump will stand up, declare he's the best president of all time, has created the best economy of all time. That'll mark the top come late 26, come 2027, anytime. And then something will panic the markets again, but the next time round, it'll be on. So crypto will go to dust. Stock markets will decline over the next, from 27 on, over the next few years. Easy lose 50%, if not more, this time round. Throughout the GFC, from October 2007 to 2009, stock markets globally went backwards 50%. So that could easily happen again, if not more, this time round. Every second one's a big one. Number 12, commercial property corrects up to 70%. So as businesses go broke and they can't pay rents, the price point from peak market, which we are today, to over the next couple of years will come back up to 70%. So the likes of office space, warehouses, industrial, farmland, vacant land, anything that doesn't have an earnings in the next couple of years will get absolutely slaughtered. And I'm already seeing it. We're in the market to buy a farm. We've been watching it the wife's been at me for nearly a decade, ever since I met her, to buy her a farm. Never quite fit the model, but we're getting to a stage now where it's now becoming an asset where I want to put my money. So farmland has cranked over the last few years, topped out around 22, 23. Since they started raising rates, farmland has started to come back and it's still softening. So, we're looking at farms for 3 to 4 million that were selling for 5, 6 million 2 or 3 years ago. So I can see the markets coming back at least another 20, 30% from today's prices. That's just farmland. And then if you look at all different asset classes, you can see office space hasn't really recovered yet. Industrial is going to get smashed. I'm seeing a lot of people getting conned into industrial, buying new off the plan type sheds, even off big buyers, agents pushing the stock. So a lot of them, I mean, some clients of ours have bought sheds and can't even rent them, own them for a year and a half, 2 years, can't even get a tenant. That's going to be becoming more and more typical over the next couple of years, is buying a commercial site, losing the tenant and not being able to replace it for up to 4 years in the hard downturn. So that's why it can correct up to 70%, because you can't then use the capitalization method to value a commercial property when there's no income coming in. It's only worth replacement value, which in a hard downturn, it's only worth land value. So whatever the cost of the land and the construction of the building on top of it, if it has one, that's what the value would be. So I see a lot of people getting caught out now and who have already bought over the last couple of years, who have bought based off a 5% cap rate. That's all hunky-dory, provided the business can stay around, regardless if they're signed into a long-term lease. If the business goes broke and it can't pay rent, which can happen with high cost of electricity and an oil shock that's going on, and you've got a government trying to raise taxes everywhere, it's going to send businesses to the wall. A lot of small and medium-sized, even large businesses will go under. Therefore, there's no more rent coming in for those commercial assets. Hard downturn. So buyers beware. It's best to buy a commercial asset in the hard downturns for land value with no income. Obviously, you need the cash. I mean, we're looking to buy this farm with probably 50% down. So we're selling out of other assets out of Queensland, raising cash to buy it. But that's the best time to buy, because you buy at the lowest price point and then it's only up from there, rather than buying peak market off a cap rate, paying a premium, sometimes double what it's worth. And that's risk, because you've paid doing that way. Buying a commercial asset based off a cap rate is you're buying the earnings, you're buying the income. But if the income disappears, you overpaid for a block of land and a shed on top of it. So buyers beware. High end, new off the plan, corrects up to 30%. So quite easily. So developers are releasing a lot of stock, being new house and land packages, new high-rise apartment buildings, which creates the oversupply scenario we see at the tail end of the boom, particularly in the regional areas and in the likes of Brisbane, Perth, Northern Territory, Darwin. In the areas that have been booming, will get an oversupply. When it becomes feasible to do a development, developers will start having a field day, releasing all the stock, market turns, oversupply. So that's type of stock comes back hard. The mining sectors will slow down as the global economy slows down. The demand for our raw materials, so coal, iron ore, will reduce as globally the crazy construction frenzy that's going on now will slow down. So then our mining sectors slow down, the jobs dry up, which we then see the likes of regional Queensland, regional WA, and the Northern Territory get hit hard, the hardest, as they enter hard downturn. So when the mines slow down and the jobs dry up, the big paying high FIFO workers on big bucks, 2, 3, 400 grand, those jobs dry up. So People can't keep paying high rents in those regions. That counteracts property prices. They all go backwards for many years, just like what we saw from, you know, 2011, 12, 13, hard downturn into 2019, 2020 across all of those regions. So buyers beware. And then at which point, when the mines are slowing down, the jobs are drying up, people start flocking back to Sydney, Melbourne to get a job where the most diversified economies are. People start seeing the writing on the wall. That's no longer a good idea to keep buying into Queensland, WA, Northern Territory when it's clearly flashing red and going backwards. At which point the demand swings back like a pendulum into the entry-level residential property market in Sydney and Melbourne. Just like what happened from around 2007, 8 and onwards, Sydney, Melbourne took off. So Sydney, Melbourne have been pretty well stagnant, especially in the entry-level stock, since around 2017. So nearly 10 years. Wages have risen. People can now see value there. It's now the smart investors are buying. We've been buying for 2 years. We get in early prior to growth cycles, and then we get the full upswing in the market. So Sydney, Melbourne are the next markets to run. We don't get caught up in all the fuss and FOMO and crazy, stupid money that goes into the other markets. Every market goes through it, the booms, the slowdowns, the stagnant periods. Timing's key. So the demand will keep swinging back into Sydney, Melbourne as the demand continues to slow out of regional Queensland, WA, Northern Territory. All the punters can't see it now. They're saying they can't see it now. The demand's coming in, all this and that. Same story we heard prior, boom. And when we started buying in Brisbane in 2018, 2019, we were buying property at a lower price point than what people paid for in 2007, 2008. So the people that are buying now in Brisbane, Queensland, WA, Northern Territory will probably end up landing themselves in negative equity over the next decade and will probably end up offloading it in the trough thinking property doesn't work. So classic cycle playing out ahead of us. And then recession, hard recession in 2028 and on. Markets recalibrate. So markets recalibrate. That's how I best describe it. When the market turns, not everything will be going backwards. The entry-level stock in Sydney, Melbourne will be actually going upwards because that's where the demand will be shifting into. Everyone needs a roof above their head. The price points are a half, if not a third of the intrinsic value. There's strong yields between 6 to 8%. 3 or 4 years ago, you couldn't get yields better than 4% or 3 or 4% in Sydney and Melbourne. Now, the yields are high. Rents rise first, creates attractive yields, prices then explode. So it's a leading indicator. Yields are a leading indicator for growth, as you never find residential real estate in solid metro or regional markets with yields hitting 10, 12, 13%, because by the time it hits 7.5%, 8%, price and follows and compresses the yields again. So it's a leading indicator we use for a growth cycle. So that's why I say markets recalibrate. The top end of town gets smashed, particularly in the regions like Queensland, WA, Northern Territory, where they've had solid runs over the last couple of years. The demand then swings back like a pendulum into the entry-level stock in Sydney, Melbourne. That's where the demand goes. That's where the growth goes over the next couple of years. That's where we're putting our money. And everything else just gets hammered. The water finds its level. And then come, mid-late 2028, when the reckoning's happening, it's all mainstream. They'll call it something. They'll call it the Trump tariff oil crisis collapse or something along the lines, or the oil crisis of 2028. The RBA will again panic, drop rates low and print a shitload of money, and that will be the stage set for the next growth cycle, and off and away we again at the races, just like what happened in the recovery post the GFC. That's how I see it all playing out. So best to get on the right side, ride the wave. There's always a market to invest in. There's always a type of property or asset class to put your money. So best to have a think about how you're geared, how you're exposed to the markets across the board, whether it's crypto, stock market, commercial real estate, residential real estate, entry level, high end, new off the plan. How are you exposed? Because as the cycle plays out, everything is impacted differently. It's always a moving target. This is a summary snapshot again of how I see each market across Australia based off the 18-year land cycle, using it first to work out where we sit in the market, just like a datum, just like a surveyor uses a datum mark. That's what we use the 18-year land cycle framework first. I study it in detail. I follow a lot of people who are also in tune with the 18-year land cycle, firstly to understand where do we sit in the market equivalent to history. And as of March 2026, it's equivalent point of time of March 2007. Now, no one has a crystal ball. No one knows exactly how it's playing out. History doesn't repeat exactly, but it rhymes. And it's the best way I've come across to work out how to cut through the noise, how to give us guardrails to operate within, to use to work out when to buy, when to stop buying, which a lot of people find it hard to do. As a lot of folks probably listening to this would see a lot of people buying in Adelaide, South Australia, WA, Queensland, Brisbane, Perth, Darwin. All the stupid money's going into these markets in the FOMO. That's when people really struggle, is they struggle to see how to buy in the likes of, say, Melbourne, Sydney, or regional VIC in 26 and not buy in these markets that are pumping. So the framework will give you that. It will give you the clarity of when to buy, when to stop buying in a market, when to renovate. I like renovating once. I like buying, like Melbourne, Sydney, regional VIC, New South Wales now. This is where we're honing in. It's like sowing your seeds in the soft market, like a farmer would sow their seeds, sow their crops when it's nice and wet and damp. And then come spring, when the market's firing, that's when the crop grows. And assuming I'm not a farmer, but summer they harvest their crop. So just like farming, sow your seeds in the soft markets, like Melbourne, Sydney, regional VIC, New South Wales. And as they all come around, come good, we pluck off low-hanging fruit, but we are mainly focusing on the likes of Sydney, Melbourne today. And then the markets will rise, you'll get growth, you can refinance that growth to not only reinvest, but then also improve your property, do renovation. So I like to renovate into a rising market when you can strip equity and then reinvest it to renovate, turn the tenant over, push the rent, and then peak market, even look at selling out. When I see, I've got properties for sale now, and moving forward, it just becomes like a rotisserie. I'll always hold maybe 10, 15, 20 properties in total, but they're only ever going to get bigger. So every year I buy a property, I sell a property, I refinance a property, and just keep rolling it into bigger and bigger deals. So I've got a house for sale in Tamworth, I've got a house for sale in Grafton. They've done extraordinarily well over the last few years. They've tripled in value. I can't see them tripling in value over the next 5 years. I see them stagnating. So I'm selling them, just like getting rid of dead wood out of a portfolio, getting rid of dead wood out of a tree, chopping the dead wood out. Get rid of the dead wood. I'm paying off the debt, raising cash, strengthen balance sheet, looking more attractive to the banks in the coming years. So when the market does shit the bed and there's deals everywhere, I'll be buying bigger deals, like blocks of apartments, where the value will be in the coming years. Right now, it's in individual. It's a lot more challenging to get better value in blocks because that's where the demand is going. Usually, you should get a discount. You should be able to get a discount per If you're buying the whole block, then individual. Now I'm finding the value in individual. So it's always a moving target of where the value is and the framework of the 18-year land stock, studying it in depth as it plays out. It's an ongoing thing. It's not like you can study it once and, oh, I understand it now and whatever. It's a constant study of where we are in the current market as it plays out, which is, I find this fascinating because it just allows me to see how everything's playing out and how everyone's going to get caught and taken out in the wash when the market turns. So hope that helps. As always, this is by no means financial advice or general advice or any advice in nature. This is my story, my thoughts, my processes of how I invest personally. Prior to making any investment decision, you should seek independent financial, legal, tax advice. If you want help building a portfolio, shoot us an email. We have now changed our model slightly. We've tweaked it. We are no longer taking big shots on who just want to go straight into blocks, big blocks, etc. I'm growing everyone from grassroots. All for buying bigger deals for people, but you got to start with our phase one and then move into phase two over time. No one's going to skip straight into phase two. It's holding up our production line. So we are helping everyone from grassroots. So if you've got 0 properties or a couple of properties and you want to build our phase one portfolio, send Alex an email. We'll send you our spreadsheet, our roadmap, which gives you all the numbers, what to expect, what it looks like, types of properties built between the 50s to the 80s, old school brick type of construction, nothing new, sexy flash. We do have occasionally bought a couple of newer builds like 2015, 2020 type builds that don't have all the gyms, lift, pools. If the clients are adamant for wanting something that looks pretty, but you pay a premium. I like the old school brick, double brick type construction, resilient as they've gone through the test of time. They'll be here for the next 100, 200 years. So that's the type of stock we like buying. We'll send you all the details on it, but we have refined our model. We want to take everyone in firstly on phase one. Once you build a solid phase one, we'll move into phase two. We're not taking anyone on anymore. That goes straight into phase two. They are painful people to deal with. So thanks for watching. I hope that helps. Until next time, see you on the next one.